Greetings, everyone, and welcome to QX Institutional Episode 2. I am Annalisa Frank, the founder of QualitaX. If you are not familiar with QualitaX, we are a technology consulting company focused on DLT-based digital transformation in the financial sector. Today is Tuesday, July the 2nd, and this episode is brought to you by QualitaX, Bluechip, and RWA World. This is a monthly roundup covering the latest development in DLT and blockchain in finance, stablecoins, and real-world asset tokenization. Our first partner, Bluechip, is an independent stablecoins rating agency. Our second partner, RWA World, is a technology-driven company specialized in real-world asset research and analysis. Let us jump straight in with part 1, DLT and blockchain in finance. HQLAx has announced in June that it has successfully passed the 1 billion euro notional milestone in outstanding agency securities lending transactions, DVD, I should precise, delivery versus delivery transaction, using the HQLAx distributed ledger technology platform. DVD is the atomic or simultaneous exchange of securities versus securities. For those who do not know about HQLAx, it's a fintech firm that leverages DLT to bring game-changing efficiencies to the securities finance and repo industry. HQLAx, again, this time with Fnality, has announced the completion of a test for intraday repo settlement on DLT with launch planned for Q4 2024, subject to regulatory approval. This is great news because under the hood of this use case, we have a cross-chain DVP between HQLAx, which is built on R3 Corda, and Fnality International Payment System, which is built on Enterprise Ethereum, so private permission Ethereum. And as per the article, interoperability is enabled through the Fnality Atomic Settlement Protocol, ASP, which uses the Enterprise Ethereum Alliance EEA standards. As you may know, QualitaX is co-chairing the EEA DLT interoperability working group. So seeing this specification being implemented in real-world use case in the banking/financial industry is definitely a great achievement for our working group, and it's a statement of the quality work we have been delivering as well and contributing to enabling blockchain interoperability in regulated settings. If you want to know more about how the EEA DLT interoperability specification was implemented in this specific use case, you will want to watch our QX Institutional Episode 3, first week of August, because we'll have by then published the full case study covering HQLAx and Fnality and detailing how cross-chain DVP and interoperability between Corda and Ethereum is achieved by leveraging the specification. So if that is of interest, don't hesitate to subscribe. Other relevant news in institutional blockchain infrastructure advancements. Fidelity International has tokenized a money market fund on JP Morgan's Onyx digital asset blockchain. We also have Japan's 3 largest bank collaborating on a DLT-based digital identity solution. And in the Middle East, we have the Central Bank of UAE introducing new set of regulatory sandbox regulations supporting blockchain and DLT innovation in finance. So those developments highlight the financial industry commitment, I think, to integrating blockchain technology into corporations. The focus on areas like settlement, identity indicate a holistic approach to adoption in general, or we would hope so. A quick word on the rise of regulated yield-bearing stablecoins. And I will not insist too much because Gareth Jones, Chief Economist Officer at Bluechip, our partner, will develop this segment further in the second part of the video. Paxos International launched Leaf Dollar, USDL, the first yield-bearing stablecoin regulated by the Abu Dhabi FSRA. USDL maintains a one-to-one parity with USD and distributes a yield from high-quality US government securities. This represents a good use case for stablecoin utility, combining stability of traditional fiat-based tokens with the yield-generating potential of DeFi. For institutional investors, this product could offer a compelling blend of security, regulatory compliance, and returns, assuming those are high-quality stablecoins. And again, I invite you to watch the second segment of this video. Also, Franklin Templeton enabled USDC conversion on his Benji investment platform for the Franklin on-chain US government money fund. A quick word on real-world asset tokenization. This segment will be developed further by Tyler and Ray in the third part of the video. However, it's worthwhile mentioning few key news. BWRE Capital has raised 3.8 million for an Italian tax credit bond on Ethereum under 6 hours. That was definitely worthwhile sharing. Bitcoin Suisse issued an investment-grade over-collateralized tokenized bond on Polygon. So we are seeing tokenization happening more and more on public permissionless network, with a key focus on Ethereum, I would say, ecosystem. However, in June, Ripple and HQLAx expanded their collaboration to bring hundreds of millions in tokenized real-world assets to the XRP ledger. We'll be following closely to see if the XRP ledger finds more traction in that space. And another asset class is being tokenized. And Fineo tokenized and transferred 9.4 million USD worth of life insurance policies on the Provenance network. As I said, those topics will be developed further in the third part of the episode. You can go straight to the end if you are more interested in real-world asset tokenization. On the regulatory side, the French Prudential Supervision and Resolution Authority, ACPR, is working on a mandatory smart contract certification. A consultation took place, and while most respondents support the concept, they are concerned about the impact on innovation, as blocking uncertified contracts could hinder EU access to new and potential innovative contracts. FalconX has begun accepting USTB, a digital token representing short-term US government debt securities, as collateral for trades. The move comes as tokenized government securities gain popularity among investors seeking low-risk, high-yield alternatives to stablecoins. FalconX executed its first USTB collateralized trade on June the 11th, following its early acceptance of Builder, so BlackRock Builder, another Ethereum-based token backed by, as you know, US Treasury bills. In other news, the Monetary Authority of Singapore has unveiled the first phase of its Global Layer 1 GL1 initiative, marking a significant leap in financial infrastructure innovation. Before I summarize the key takeaways from the report, which is around 20 pages long, I want to read for you a paragraph that summarizes well what this initiative is about. So this starts on page 7. The GL1 initiative aims to foster the development of a shared layer infrastructure for hosting tokenized financial assets and financial applications along the financial value chain. GL1's infrastructure will be asset agnostic. It will support tokenized assets and tokenized money issued by network users, so regulated financial institutions, from various jurisdictions in different currency denominations. This could streamline processing, support, and automated instantaneous cross-border fund transfer, and facilitate simultaneous forex exchange swap and securities settlement based on fulfillment of predefined conditions. Okay, so that provides a good overview of what the initiative aims to achieve. It seems that the approach is to embrace a public permission blockchain model for the shared ledger infrastructure. So the goal will be to balance openness with regulatory compliance. You can read more about that on page 7. The second one, if you go to page 10, you will have the architecture overview for the GL1. You will see the focus on composability. It seems that the goal is to enable seamless interaction between different financial services on a single network. The key focus is on cross-application composability. The service includes interbank transfers, cross-border payments, trade finance, cleared margin, collateral management, asset wealth management. Something interesting that I've read a bit further down is that the initiative does acknowledge the possibility for redefining traditional roles, such as those of central security depositories. That will be interesting to see what the concern and the relevant stakeholders think about that. Another takeaway is the comprehensive scope. GL1 aimed to move just like beyond just issuance of assets. It aims to integrate trading, settlement, payment, corporate action on one single platform. And also to finish, if you look at the last line here, it aims for multi-asset support. It plans to accommodate securities, so native securities, tokenized bank liabilities, so tokenized commercial bank money, for example, wholesale CBDCs, etc. In terms of who is involved in this initiative so far, there is BNY Mellon, JP Morgan, Citi, and Société Générale Forge, among others. One thing that I've noticed is that all of those stakeholders, from what we know, have a bias toward Ethereum technology. This will mean that it could be that GL1 would most likely be built on Hyperledger Besu. Who knows? I don't know. This is just speculation. Another very interesting report that was released in June is the Broadridge DLT in the Real World survey in collaboration with Accenture and Ripple. There are a couple of findings that I found personally very interesting. The first one, obviously, being on interoperability. 81% of the respondents currently are working on interoperability. If we go to page 25, we will see that the core focus is actually at the application level, with 42% of respondents focusing on technical processes of transfer, 38 focusing on data model, so data interop, and 31% focusing on legal validity of transfer. 44%, which is the number that I personally found very interesting, are actually working at the network level for the legal validity of transfer. For a bit of context, this survey included 343 respondents globally, with a bit more than a third located in Europe, 30% in North America, 19% in APAC, and the rest split between Latin America and Africa and the Middle East. The second finding, which is quite interesting, is while 66% of the DLT-based initiative are now driven by real business benefits, so cost, revenue, treasury benefits, yet 86% of core business users still don't see the value in DLT. So on one side, we have those initiatives which are now trying to deliver real business value, but core business users still do not see that value. If you go to page 19, we may have some, high-level understanding of what are the key barriers to growth. And without surprise, 80% of the respondents basically name the lack of compelling business case and ROI as a key challenge to accelerating growth, at least on the sales side. The second one, which is limited liquidity of tokenized securities, and the third one being around regulatory consideration, legal certainty around recognition and status of digital assets. I will go back to the key findings here. Distributed ledger technology has never been more important, particularly for financial market infrastructures and wealth managers. They see it at least 10% more important than they saw it back in 2023. Another key, I would say, takeaway is without, again, surprise, more than 50% of the projects in 2024 will be focused, according to the respondent, on tokenization. With money market funds, so tokenized money market fund, seeing a 13% increase in activity, and bonds emerging as the central asset class. I will not dive deeper into this report. As I said, it's very interesting and extensive. It is a very valuable survey to the space. I think I only hope that maybe next year it includes more respondents to have a broader view of the market. The last report or paper that I would like to cover this month has been released by the Paradigm Policy Lab and written by Natasha Vassan. This document looks at the challenges and potential solutions for settlement finality in blockchain-based financial transactions, particularly focusing on the Ethereum ecosystem. It looks at well-known TradFi mechanisms such as DVP, delivery versus payment, which, as you know, is crucial for mitigating principal risk in financial transactions. The paper explores that while this is a bit more complicated to achieve within a public permissionless space, it's actually not impossible. One of the key points is that for single chain transactions on Ethereum, simultaneous DVP settlement is actually the norm, and that for transactions occurring entirely on Ethereum, there is typically no principal risk at all whatsoever. The main point covered is that the real challenge is when we have hybrid transactions. Transactions that involve both on-chain and off-chain components, or transactions that are across different blockchain networks. These hybrid transactions introduce settlement risks that need to be addressed. So here on page 4, we see traditional DVP, and on page 5, we'll see the single chain transaction happening on one unique blockchain network. And on page 6, we see the hybrid transaction, so cross-chain DVP transaction or DVP transaction requiring on-chain and off-chain components. So from page 7, the author tried to explain why those hybrid transactions are actually a problem and how it affects institutional adoption of DeFi. For example, due to the risk in cross-chain MEV, how there are limits, to interoperability with other tokenized systems and potentially how it undermines public confidence in the entire system. And by this, I mean the Ethereum-based system for financial transaction. From page 9 to 17, it's all about addressing those challenges one by one and proposing a range of solutions. The author classifies those solutions under 3 categories: technical, legal, and market-based. On the technical side, so if we go here, we have everything related to innovation in cross-chain messaging, public-private blockchain communications are discussed. Also, the projects such as Chainlink CCIP and other experiments are mentioned as potential solutions. On page 12, legal solutions are explored, including options to establish a legally recognized moment of settlement finality for blockchain transaction. And on page 13, market-based solutions are explored, and they include ideas like decentralized settlement insurance or other interesting proposals such as the creation of a central counterparty for hybrid transaction, which could help manage and distribute settlement risk. This is here. That is it in a nutshell. This paper touches on the need to address operational risk, like settlement delays due to network congestion. It also suggests potential legal obligation for off-chain agents to ensure timely inclusion of transfer on public blockchains. In summary, it provides a comprehensive overview of settlement finality challenges in blockchain finance, and it covers a wide range of solutions. So it's an excellent starting point for further research. And that is it on my side. We covered a lot in this first segment of QX Institutional episode 2. I wish you a beautiful end of your day, and I will see you next month.
Welcome to Bluechip on Stablecoins. I'm your host, Garrett Jones. I'm Chief Economist at Bluechip, the independent stablecoin rating agency. Check out our ratings at bluechip.org. I'm going to start off this week with some economic commentary, drawing on the latest news in stablecoins. Then I'll have a brief economic analysis of Tether's new gold-backed stablecoin, Alloy. And I'll finish with a short history of bearer bonds and what these old financial instruments can teach us about the modern push to get real-world assets on the blockchain. So, let's turn to the news. Here I'm drawing on Bluechip's weekly news roundup, which comes out every Monday on Twitter at bluechip_org. So, European regulators might be pushing crypto exchanges to throw out the baby with the bathwater when it comes to stablecoins. Crypto exchange Uphold says that they're going to be ending support for some stablecoins, And they say that's due to upcoming MiCA regulations in the EU. As a lot of you know, the MiCA regulations are the European Union's attempt to regulate stablecoins and make them safer for users. So the affected coins, the ones that withdraw support for, include USDT, DAI, FRAX, GUSD, and USDP. Now this list of 5 coins includes 2 coins that do have pretty weak reviews from Bluechip. Both Tether and FRAX have D ratings, but it also includes 3 coins that have pretty solid ratings from Bluechip. That includes DAI, Pax Dollar, and Gemini, GUSD. Those have ratings ranging from B+ to A, which are all pretty solid ratings. So MiCA rules, MiCA regulations may be pushing crypto exchanges to withdraw support for coins that Bluechip finds relatively safe. It's worth noting that the exchange will automatically convert these remaining balances. Uphold says they'll convert those remaining balances into USDC, Circle, on June 28th. So you've got, by the time this story is released, the exchange will have already occurred. So with that, let's turn to a question of jobs. A Circle spokesperson says that the firm's hired about 15% more just since the beginning of the year, and they've added 137 employees. I think this is a sign of how hiring intensive the world of crypto, especially the world of stablecoins, will be, particularly for those organizations that are trying to stay on get a thumbs up from the world's financial regulators. So currently Circle has over 140 additional positions open in sales, engineering, and marketing. So if you're looking for work in the field, they seem like a nice place to work. I've met some great people. And turning to some additional news, a new coin with real-world backing, to me it's noteworthy because it's set up as a Wyoming trust. As many of you know, the state of Wyoming has been making some efforts to be crypto welcoming and stablecoin welcoming. And so D-Trinity's DUSD has been introduced, and it's going to be backed by a fairly conventional mix of bank deposits, money market funds, and USDC. So Bluechip has not yet rated this coin, but the fact that it's set up in Wyoming seems to make it newsworthy. So another piece of, I think, important news is that Moody's has rated a tokenized U.S. Treasury bill fund. It appears to be the first rating of its kind for a U.S. Treasury bill tokenized fund. So this new fund is Open Eden Labs fund called just T-bill, and Open Eden Labs has been given an A grade for this bond fund. So Moody's has a special set of ratings for the funds themselves. Moody's expects that the fund itself will hold overwhelmingly AAA rated assets, but they have to rate the fund separately from the assets itself. What Moody's says in their discussion is that the organization that's managing it just doesn't have a lot of experience. They don't particularly penalize it because it's on the blockchain, but they do draw on some minor concerns about potential technical problems. They also note that an Ernst & Young audit mitigated some of their concerns. So this is a sign that at least Moody's is willing to assess tokenized funds, and in this case, tokenized T-bills. In January, Moody's also rated a Singaporean tokenized fund. And so this is a sign that the ability to rate tokenized funds is something that at least Moody's feels that it's up to their competence to assess. It's worth noting that in this particular fund, the T-bill fund, a record of all transactions will be held both on and off chain. So if one was hoping that we would be in a world where transactions for tokenized funds are strictly on chain, we are not there yet. That maybe this is just a transition, time will tell. But the world of tokenized funds seems to be moving forward with more institutional approval for at least a reasonably well-managed fund, like apparently this is. There's also some news about shutdowns. So Switzerland's financial regulator has shut down a bank that was known as a crypto-linked bank, Flowbank. And they just said it didn't hold enough capital. It breached its minimum capital requirements. So its assets were getting to be close to their liabilities, close enough to their liabilities, that the Swiss financial regulator shut it down. And according to reports, Flowbank held assets for TUSD and for which is true USD, TUSD, and for a crypto project known as Anchored Coins, which had something called AEUR and ACHF. So it's worth noting that regulators are keeping an eye on banks that are holding assets for crypto funds. And our final news story is a story of a stablecoin that claims to be another Athena, but at least at present looks more like another Luna. So Asymmetry and Ampleforth are launching something called AFUSD, and this is a coin that claims to not really need to hold collateral. The world of stablecoins so far has been a world where the successful coins are backed by collateral, are backed by either real-world assets or over-collateralized by some form of crypto. And the question is, can any stablecoin exist that doesn't follow this pattern? I think I'm personally, as an economist, quite skeptical of that for any time in the near future. A spokesperson for the project said that AFUSD has discovered a method for, quote, and this is a quote from a news story, eliminating the need for conventional collateral and associated risks. So if you think you don't need the collateral to back your coin, well, it's extremely likely that Bluechip will not be giving your coin a very good grade. I don't want to speak officially for what will happen in this case, but the need for collateral, the need for credible backing for a coin is important for the world of stablecoins. Banks that succeed, national currencies that succeed, tend to have some form of backing that's credible. Sometimes that's something very concrete, like US dollars held by many countries across Southeast Asia. It might be gold held in reserves by the US in the 19th century, or it might be a country's ability to borrow assets in the event of a crisis, a good credit rating, the ability to borrow massively. But in all these cases, either current collateral or a good enough reputation that you can borrow a lot of collateral on short notice appears to be crucial to keeping your currency stable. This is a lesson that stablecoins, I think, are going to keep relearning again and again. May not happen in a week, may not happen in a month, but this lesson will continue to be relearned. With that, we'll close our coverage of Bluechip's weekly news roundup. In our next segment, I'm here to talk about Alloy. That's Tether's new gold-backed stablecoin. In a lot of ways, Alloy is like a lot of other over-collateralized stablecoins. We're familiar with stablecoins that are over-collateralized by most often Ethereum. What makes Tether's new gold-backed stablecoin a bit different is that it's actually backed by another form of a Tether asset, that's Tether Gold. So as many of you know, Tether Gold is a coin that is pegged 1-for-1 to the value of more or less an ounce of gold. And so Tether has decided to offer a stablecoin where people can choose to over-collateralize the stablecoin with Tether Gold and then create a stablecoin, mint it, and use it in transactions. So if one was wondering a gold-backed coin, this is now your opportunity to have that. So I'd like to explain briefly how the sort of over-collateralization works, in particular how the liquidation works. The current rule is that the coin has to be over-collateralized. 1 unit of Alloy has to be over-collateralized like this. So if you can post $100 worth of Tether Gold, that allows you to mint $75 worth of Alloy. So I think of that as a 33% over-collateralization rate. You have a $75 worth of Alloy, $100 worth of Tether Gold that's backing that, 33% over-collateralization. And there's an automated market system that will happen in the background so that if, hypothetically, the price of gold collapses so much that your coin is now under-collateralized, then an automated market process would end up liquidating your holdings of Alloy and would basically grab your collateral as soon as possible. So this is, it's a way to make sure that that there's at least a moderate degree of backing in fairly serious gold market collapse scenarios. So if you post your, say, $100 worth of collateral and you've traded away your Alloy tokens, you might ask, well, how do I get my collateral back? And the answer is you have to go get some more Alloy. So if you posted $100 worth of collateral, you minted your $75 worth of alloy, and then you sold it or traded it some way, gave it away. If you wanted to get that collateral back, you've got to go and find a way to get your hands on 75 bucks worth of alloy again. Then you could redeem your collateral with a fee. So there's a fee for redemption, but that's normal at this point in the field. And there will also be fees if your collateral gets seized. So that gives people an incentive, these market makers an incentive to go and close out those positions. So how safe is something like this? What is the risk of a big gold price collapse? The last few years have been a time where gold has run up and then stayed kind of stable. Well, just looking back at the last 50 years, there have been two huge price declines. If you look online at a place like, say, macrotrends.net, you can find a listing of long-run gold prices. And what you'll find is that the two big price declines were in the period of 82 to 2000, and then right around 2014 or so. In the first case, it was there had been a big run-up in the price of gold through the craziness of the 1970s, the weak and intermittent battles against inflation of the 70s that only ended when Paul Volcker took the bull by the horns and really crushed inflation. That victory over inflation in 1982 really killed the US gold market for decades. So there was an immediate drop in gold prices. And those gold price collapses would have been enough to trigger a collateral acquisition at current collateralization rates. So if alloy had existed back then, that era would have been a period of some collateral seizures in the world of alloy. So 82 to 2000, there was much more than a 50% drop in just the nominal dollar price of gold over that period. So quite serious. Again, 2014 or so, once the world looked around and said, wow, it looks like the worst of the global financial crisis is behind us, once again, there was a decline in the price of gold that would have been just about enough to trigger a price collapse, right in that ballpark, depending on the years you pick. And so, gold price declines have happened in, the last 50 years, twice substantial. One was basically decades long and systemic, almost 2 decades long. So don't take it for granted that the price of gold is stable or is likely to go up. It's a volatile asset, as so many commodities are. So you might be asking yourself, why would you want a coin that is backed by gold rather than, say, a coin backed by U.S. Treasuries? I'm speaking here in terms of dollar stable coins. One reason is sentimental. Some people just like gold. They feel there's something substantial to it. I can't dismiss people's sentimental motivations to wanting to have some of their stable coins backed by gold, which has been an endless, very long-term form of metal that's been beloved in cultures around the world. But another more practical reason might be if you believe that gold is likely to dramatically rise in price. If you think, for instance, the dollar would collapse. If you think medium to high inflation is pretty likely in the next few years, then a gold-backed coin would actually have more value in a dollar collapse, not less, right? So big increases in gold prices mean you have more collateral, mean your collateral that you've posted goes further and further over time, not less and less over time. So if one is a big believer in moderate to high inflation risks in the US in the next few years, then it's a reasonable reason to hold something like alloy. Here I'm not speaking to the Tether ecosystem, to the legal documents underlying it, to the trust mechanisms underneath it, to its audits. Here I'm just speaking to the raw economic question. If you had a coin that was over collateralized with gold at about this rate, would it be a reasonable choice? And the person for whom it would be a reasonable choice would be someone who sees medium to high inflation on the horizon in the near future. So we'll continue to see more innovation. For most purposes, you'll want to be thinking about coins that are backed by the same kinds of assets that the coin is denominated in. So U.S. short-term treasuries as a backing for U.S. dollar stable coins is a reasonable place for a lot of people to start. There's going to continue to be innovation in this field, and I'm glad to have people try out new and innovative ways to back their stable coins. In our final segment, we're going to talk about bearer bonds and the lessons that bearer bonds have for the migration of real-world assets onto the blockchain. So bearer bonds emerged in the late 1800s as a convenient form of a debt security. It was a way for bonds to be as anonymous as currency. One thing we take for granted with currency is that there's no record of who's had in the past, and every time two people engage in a financial transaction with currency, nobody needs to keep track of who gave up the currency and who received it, right, as a general rule. Bearer bonds worked just the same way. They were bonds that, for instance, consider a General Motors 10-year bearer bond with a face value of $10,000. If I have one of those and I wait my 10 years and I walk to General Motors, I can hand them that bond and get the $10,000 promised on the face value. They don't need to know who I am. They don't need to know where I got the bond from. If I bear it, I get the value. And this was you can imagine there are a lot of reasons why some white folks would like that. Some are, people would often naturally think of tax evasion reasons, but also in a world before easy electronic transactions, before easy electronic recording of transactions, having to get paperwork or attorneys or notaries involved at each stage in a bond transaction was just a hassle. So in a world of higher transactions costs in the world of financial markets, bearer bonds were a lot more appealing to a lot of folks. So in the 80s, these things fell apart. The bearer bond market was annihilated, in particular by the 1982 TEFRA, Tax Equity and Fiscal Responsibility Act, which was signed in the United States during the Reagan administration. This is a bill that, among other things, repealed some of the Reagan tax cuts. And the 82 TEFRA bill included some provisions that essentially taxed bearer bonds out of existence. And what the government was worried about is that they were losing a lot of tax revenue from these bearer bonds. And if the government made them harder to own, then the government would raise some more revenue from people who were trying to avoid paying taxes on interest. So I should mention that these bonds, which were often very pretty, if you look at pictures of old stock shares or bonds online, they often were quite elegant. These bonds had coupons around the outside, and the coupons were the way that a person would get paid each year's interest. So a 10-year bond, in a simple case, would have 10 little coupons, and whoever had the bond could just present that bond to General Motors and tear off the coupon and get that year's relevant amount of interest for the bond. So that's where the term coupon clippers came from. It was often a physical process of cutting off coupons and handing them to redeem to get enough interest to live on each year for certain wealthy people. So over time, bearer bonds, the bearer bond market dried up, not just in the US, but in most of the world. But it's worth noting that Europeans actually kept a fair amount of the bearer bond market alive. In particular, Germany, Switzerland, as two larger countries with important financial traditions, they kept bearer bonds alive. And the rules are tighter than they used to be, but they still exist. And I just have to say the German word for bearer bond. It is Inhaberschuldverschreibungen. I think that's just a great word, and it captures the idea of a bearer bond. So, and it's worth noting with new rules, bearer bonds are still generally kind of anonymous, but in order to keep the market alive, there have been some accommodations that have created situations in which, in certain cases, information about who holds the bond can be released. So some privacy rules have been weakened so that the governments can allow these instruments to exist in some form. We should be thinking, it's always, we all know the many reasons why governments and citizens don't like there to be a lot of large financial anonymous transactions. But there are and I could list those, but you've heard them all already. But let's think through some legitimate privacy reasons here for why bearer bonds might be reasonable, and why people who want anonymity shouldn't always be stuck having to use cash. First of all, just some people just have an interest in privacy. They might be interested that some people might want to attack them, some people might want to get a hold of them, some people might want to engage in kidnapping if they think that the person's worth a lot of money, right? So financial privacy is valuable for just run-of-the-mill personal reasons, but it can actually be a matter of public safety, especially for people who live in countries where kidnapping and other kinds of threats and extortion are much more common, and where the government might not be able to or might not be interested in prosecuting people who engage in that kind of bad behavior. It's also that some people might want some financial privacy just in their business transactions. If you're trying to make investments or acquisitions without tipping your hand to other competitors, a bearer bond might be one easy way of engaging in a transaction without letting everyone immediately know who you are. Keeping privacy in financial transactions is sometimes pretty valuable. Walt Disney learned this himself when he bought up the land for Disneyland at a very high price. Once people learned Walt Disney wanted the land in California, they jacked up the price. So when he moved and tried to build Walt Disney World in Florida, he built a number of shell corporations that had funny little names that made vague allusions sometimes to Disney products. But keeping some anonymity made it easier for him to not get ripped off when he went to buy land in the Orlando, Florida area. So financial privacy can be important to us as individuals, and it can have legitimate business purposes for people in the business world trying to engage in financial transactions. A little bit of people shouldn't always assume that anonymity is nefarious. And I think to pick an important issue is that some people might want to hold bearer bonds if they're trying to escape some domestic abuse situations, if they're trying to get away from difficult personal situations in their personal life. A bearer bond might be an easy way to just get away with some money, some assets, some wealth in a way that can serve as a protection for the future. Again, people shouldn't always be forced to use large amounts of currency as a way to get themselves some financial privacy in dangerous situations. So, with these reasons in mind, how can the world of tokenized real-world assets draw on the lessons of bearer bonds? I think the key lesson here is that there's some room for compromise. Just as European governments made some compromises to allow small amounts of some compromises on privacy in certain situations, tokenized real-world assets can similarly find some kind of in-between point between full disclosure of each transaction and full anonymity. We know that full anonymity won't fly for many purposes, and keeping an eye on the compromises that the Swiss and the Germans in particular have made when it comes to bearer bonds will offer important legal lessons for the world of tokenized real-world assets on the blockchain. Thanks for joining me for this month's episode of Bluechip on Stablecoins. I'm Garrett Jones, the Chief Economist at Bluechip, the independent stablecoin rating agency. Be prudent, have fun, and keep learning.
Hello, everybody, and welcome to another episode of QX Institutional. My name is Tyler Sherwin, and today I'm joined by our head of research, Ray Buckton. RWA World is a thesis-driven technology company specializing in real-world assets. It's our mission to bring clarity and transparency to the tokenization landscape. We focus on the research and categorization of tokenization trends and market developments. Today, we're going to be sharing some regulatory, institutional, and ecosystem developments. Ray, could you kick us off and talk a little bit about some of the shifting preferences we're starting to notice in the investment market?
Absolutely, Tyler. Very excited to. June has been a watershed month specifically for revelations regarding the digital asset preferences of different generations. As you can see here on the screen, the Bank of America recently conducted a survey, and the age 21 to 43 range had a massive revelation in terms of their shifting preference. In aggregate, 31% of asset composition favors crypto and alternative investment. Compare this on the right-hand side to the age 44 plus range, which has 1% and 5% respectively for crypto and alternatives for an aggregate of 6%. As you can see, the tides are shifting monumentally. People are asking the question, is the 60-40 rule dead? After over a decade of near zero interest rates for bonds, and now near 5% rates for bonds, to see that crypto and alternatives is such a favored group of asset classes for younger generations really demonstrates that the tides have shifted in ways that are still unfolding. So it's a very interesting time to be in the markets.
And I think anyone who has been in the markets for a little while wouldn't be surprised by this. And given the unprecedented nature of where rates have been and just some of the major developments with inflation flying so high, people are looking for alternatives and they're looking for different options. And so it makes a lot of sense that people would be thinking about crypto. In the terms of tokenization, this is always a very fascinating concept to us because we see tokenization as democratizing access to even more alternatives than would previously be available. So it's definitely a trend that we're going to keep an eye on. So why don't we talk a little bit about some of the institutional developments, Ray? Obviously, we've heard a lot about BlackRock and a lot of the major institutions like JP Morgan getting into the tokenization game. What are some of the highlights from the month of June?
Absolutely. So as you can see on the screen here, the DTCC, Euroclear, and Clearstream have collaborated together with Boston Consulting Group, BCG, which is the entity responsible for, as you recall from last month's installment of the QX series, the $16 trillion by 2030 tokenization prediction. Well, these three entities collaborated with BCG for a digital asset control framework to get a better understanding as to how larger depository institutions and banks and other large institutions focused in the realm of finance can better handle digital assets in a way that ensures all risks are accounted for and that counterparties can transact with confidence and security. Additionally, you can see JP Morgan's Onyx has been having a field day. The asset management giant Fnality, which has begun mining Bitcoin in 2015, by the way, decided to join the Onyx network. And as well, the JPM coin has exploded in terms of transaction volume due to the fact that they opened it up to external development parties. We're seeing for the first time a very large institutional private blockchain network start to have a bit of a runaway in terms of market share, which is very exciting for the JP Morgan team. Additionally, Deutsche Bank has joined the Singapore Project Guardian, which is an ongoing project since the late 2010s focused on asset tokenization. It involves a consortium of banks, financial institutions, and regulators, and Deutsche Bank has joined to explore asset tokenization applications in tandem with its peers. So, very exciting developments on the institutional front, and we'll be keeping an eye on these as they continue to evolve.
Yeah, it seems to me, Ray, that these institutions are getting a little bit more open to collaborating. You mentioned Onyx opening it up to other external developers and teams who want to get involved. I see this as sort of an evolution towards more of the public blockchain rails and less on the private side. But I still think that these two ecosystems will exist side by side. It's just that the entrances and exits will probably be closely monitored. Do you see it the same way?
Absolutely. There are certain tools for certain purposes. Naturally, public blockchain tokenization, as we've seen with BlackRock and the Biddle Fund, has its place in the world, and it's becoming very much more in vogue. However, incumbents and traditional financial institutions are very accustomed to these sort of proverbial black boxes in which they operate, and ultimately are less keen to give up all operational transparency control. And for good reason. There's counterparty risk, as we can see by the DTCC, Euroclear, and Clearstream working on this digital asset control framework. As I like to say, it is day one, inning one, pitch one for tokenization, and I echo your sentiment that the private and the public blockchain rails will develop in tandem, and it's exciting to see JP Morgan running away with a bit of the lead in terms of the private blockchain sector.
Yeah, definitely. And that control framework was fascinating to read through and see how they're thinking about risk management in this space. And one of the reasons why I think we're starting to see more institutions get involved is, of course, some of the regulatory developments. It's been good news items, but then there's also been a few minor setbacks as well. Could you talk a little bit about what the regulatory landscape is looking like for tokenization today?
Absolutely. If the month of May was considered a blockbuster proverbial win for tokenization and crypto assets, ultimately June was a bit more of a measured month. However, there were some fantastic wins. The SEC ended up dropping its ongoing investigation into the Ethereum aligned giant consensus and will not be continuing with its lawsuit regarding the ETH 2.0 proof of stake migration. They do not believe it to be a security based on the precedent at this time. This is a very interesting development due to the fact that the migration to proof of stake was indeed the basis for the lawsuit to begin with. So it opens up a question over the months, quarters, and years whether other proof of stake networks, should they attain sufficient decentralization, whatever that may mean in the eyes of the regulators or the networks themselves, also qualify as non-securities. With the ongoing development of FIT 21 and other regulatory pieces of legislation coming down the pipeline, that's yet to be determined. Additionally, the Bank of International Settlements and the Bank of Canada have launched an innovation center out of Toronto, and the innovation will likely include tokenization. While blockchain was not mentioned by name in the actual prospectus, it goes without saying, with tokenization becoming such a salient force in traditional finance, that it should be something that would be reasonably focused on, if not implied. And additionally, in terms of the less positive news, SAB 121 was vetoed by President Biden, despite passing in the United States through the Congress. Ultimately, the executive decided to veto this legislation, stating that it would impede the SEC's ability to undertake enforcement action. So, what this means is that we are still left wanting for ultimately banks being able to take custody of digital and crypto assets on behalf of their clients. And while Anchorage Digital and other trust companies are indeed celebrating this veto, ultimately it shows a shifting mentality and a shifting foundation in terms of the perspective of digital assets in the halls of power in the United States.
Yeah, I'm a little disappointed by the veto, to be honest. Last month we talked about it, and I was actually predicting that Biden would, in fact, not veto this again, despite the fact that he threatened it, because there was a lot of political pressure that's been brought to bear. I think since he's vetoed this, the Democrat side of the aisle has definitely gotten a little bit more friendly towards digital assets. We'll see how that shapes up. I think most people and most major institutions are thinking to themselves that they'll wait till after the November elections to see where things stand. And so, unfortunately, it seems like we might be having to wait for that time to get the sort of clarity that people are looking for. But we have good news on the horizon, just like you mentioned with ETH 2.0's migration not potentially being a security now, according to the SEC. This is exciting for the industry, especially with the ETH ETFs going live at the beginning of next month. So that's definitely going to be something we'll be talking about in our next installment. Let's move on to some now ecosystem developments. This is one of the areas that we get pretty excited about. All the different products and teams that are building in this space. Could you tell us what are some of the highlights from the month of June?
Absolutely. We've seen some fantastic developments over the month of June regarding the ecosystem of tokenization, as you can call it. Provenance, one of the largest tokenization networks that is public and partially private due to its zones, has tokenized $9 million worth of on-chain insurance with its partner Infinio. This is a very powerful move due to the fact that insurance is a comparatively underrepresented category as it pertains to asset tokenization. However, without proper insurance, ultimately the modern economy cannot function. So what this represents is a migration, not for the first time, but perhaps the most significant, with insurance into an on-chain environment. And working with an entity like Provenance, which has 64 validators, including Franklin Templeton Benji Investments, it is a very powerful move and a very compliant one from the looks of things. Additionally, we've seen Superstate and their USTB fund use this collateral in conjunction with FalconX. USTB is a short-dated treasury fund, and FalconX was able to use this tokenized treasury instrument as collateral in some of its lending activity. This demonstrates the ongoing interpolation of traditional finance and decentralized finance, and the compliant tokenization occurring with highly valued treasury assets, now with a 5% yield. With yields in DeFi now often going below that 5% threshold, there's an increasing interest between this interpolation and the interplay between traditional and decentralized finance. And Chainlink has topped real-world asset crypto development again for 2 months running. And ultimately, as you can see on the left-hand side of your screen, this is from the analysis firm Santiment. And you can see Chainlink very firmly at the top, followed by Synthetics and Centrifuge, and all the way down you have IX Swap, Defactor, and Reserve. Chainlink is continuing to lead the way in terms of on-chain development and has become quite the giant in terms of its ability to innovate for the digital asset space.
Yeah, I don't know of any real world asset companies that are worth their salt who are not working with Chainlink when it comes to the tokenization of real world assets. This analysis is fascinating because it looks at the activity in GitHub for the developers. And so Chainlink continues to lead with just some of the most active development in the real world asset space. And then seeing the news from Provenance, Superstate, and FalconX just goes to show that there's continued development in the ecosystem for tokenization, lots of progress being made. It is a very exciting time to be building in the space of tokenization. So I hope this has been helpful for our audience. This has been, once again, the June summary of the tokenization landscape. RWA World does manage the largest publicly available database. We recently crossed our threshold of 400 real-world asset companies that have been tokenized in our database. And so if that is something that might be interesting to you, the viewer, please take a look at our website, rwa.world, where you can find a list of all of these different real-world asset companies. And then also take a look at our newsletter, where we document some of the latest developments on a weekly basis. So a lot of these highlights and a lot of this information is condensed from that newsletter. So I hope this has been helpful for our audience. Thank you so much for watching. Ray, thank you for sharing your insights with us as our head of research, and we'll see you all in the next installment of QX Institutional.